Welcome back to Talk Tickers. Today, we're diving deep into MakeMyTrip's third quarter earnings. Now, this was a wild one, a quarter that was really a tale of two completely different stories. And, well, the market picked a side, and boy, did it pick the ugly one, sending the stock into an absolute freefall. So we're going to break down exactly what went down and what it all means for the next call. All right, let's get right to it. The big, flashing, red number that screamed from this report wasn't about revenue or bookings. It was this, negative 12.9%. Just ouch. That was the damage in a single day. A brutal, punishing sell-off that completely erased months of hard-won gains. So you've got to ask, right? What on earth did investors see that spooked them this badly? Well, the answer is what we're calling the Great Disconnect. It's like management and the market were watching two totally different movies. See, on the one hand, you had the company painting this picture of incredible strength, record-adjusted profits, everything's looking great. And then on the other hand, you had the official accounting numbers, the GAAP earnings, and those, well, they just fell off a cliff. And here it is, laid out in black and white. This is the heart of the whole drama. Look at the left side, the official GAAP earnings per share, just 7 cents. That's a massive tumble from 23 cents last year. But then you glance over to the right at the number the company wants you to focus on, their adjusted EPS. That's 52 cents, up nicely from 39 cents. Now, when you see a gap that big, alarm bells start ringing. Investors get really antsy. And this time, they sprinted away from that GAAP number like it was on fire. So what caused that collapse? Was the core business falling apart? Nope. And this is the key. The problem wasn't that people stopped booking flights or hotels. The villain of this story was a nearly $28 million spike in net finance costs. Yeah, I know, it's all tied to these complex things called convertible notes. So really, it's an accounting thing, a financing thing. But for Wall Street, which loves a clean, simple profit number, this was a giant, waving red flag. And the market didn't just whisper its opinion, it shouted it from the rooftops. Just look at the trading volume here. It absolutely exploded. We're talking going from about 1 million shares traded one day to over 6 million the next. That's insane. This wasn't just a few people getting nervous. This was a full-blown stampede for the exits. The message was loud and clear. All that complicated finance stuff mattered way more than the rosy picture management was trying to paint. Okay, so we've seen the market's brutal take. But what was the other side of the coin? Let's dive into management's narrative. Because during their earnings call, they were telling a very different story, arguing that Wall Street just wasn't paying attention to the right things. Their whole argument really came down to 3 key points. First up, they touted record profitability. Now remember, this is on their adjusted numbers. They hit over $50 million in adjusted operating profit for the very first time thanks to selling more high-margin stuff like hotels. Second, they pointed to a nice little tailwind from a government tax reduction on hotels that got more people booking rooms. And finally, they really leaned into their tech story, showing off that their AI chatbot, Myra, is now handling over 50,000 customer chats every single day. And to really drive that tech point home, the CEO, Rajesh Magao, said this: "We see AI as a very welcome and positive tech revolution, opening up many new opportunities in our business." So you see what they're doing, right? They're trying to shift the whole conversation away from quarterly accounting issues and towards the future, towards innovation and long-term growth. A great story about the future, for sure. But here's the thing. The market wasn't interested in a story about tomorrow. It was laser-focused on the problems of today. So let's flip back to the bear case and break down the big worries, the headwinds that really sank the stock. It really boils down to 4 main things that were bugging investors. First, a real, tangible operational problem. There just weren't enough flights in December because of new pilot rules. Second, an optics problem. That same tax change that helped with bookings also made their revenue growth look kind of weak. It's confusing. Third, they were spending more on marketing, which squeezed margins. And finally, the nail in the coffin, Wall Street basically agreed with all the worries, with analyst after analyst cutting their price targets. And let's quickly explain that weird acronym FDTL. It stands for Flight Duty Time Limitation. Basically, these are brand new, much stricter government rules about how many hours pilots can work, and they kind of came out of nowhere. The result? A whole bunch of flights got canceled or messed up right in the middle of the super busy December holiday season. It was a real shock to the system. All right, so you've got the rosy picture from management on one side and the market's doom and gloom reaction on the other. Now it's time for the big finale. Let's pull all of this together and figure out what it all means. What can we expect next quarter? And more importantly, what's our call on the stock? This is what it all comes down to, right? After all that chaos, all that noise, what is the actual trade here? Okay, here's how we see the next quarter shaping up. First, revenue growth. We think it's going to be pretty muted. Those flight capacity problems probably aren't going away overnight, and the company even warned that year-over-year comparisons will look tough. As for adjusted profit, we're calling for it to be stable, maybe even down a little. The good stuff is going to be fighting against those headwinds in air travel. And the big one, the stock price, we think it's probably going to trade sideways or even drift lower. The market is basically telling the company, don't tell us, show us. They need to see a clean quarter before they're willing to jump back in. Which brings us to our official rating heading into the next report. Underperform. And our thinking here is pretty straightforward. First, the rules of the game have changed for this stock. The market is now focused on that bottom line GAAP profit. Second, those air capacity issues are a real near-term drag. Third, all those analysts cutting their price targets, that puts a lot of pressure on the stock. And finally, that cool AI story they're telling, it's a great story for 2027. It's just not powerful enough to make investors forget about all the problems they're seeing right now.
And remember, this is not financial advice.